help you build a movement, celebrate, and inspire climate action.
So that was SwitchOn for all of you. Today's session, which is co-organized by and co-hosted by SwitchOn Foundation, Green Bengal Innovation Network, and Vijay Krishna Girls College. Green Bengal Innovation Network is a joint initiative of SwitchOn Foundation and Network for Global Innovation, NGIN, a startup ecosystem organization based out of California. And from NGIN, we have our speaker also today, Mr. Paulo, who is representing the investments of NGIN. So we will also hear him in a couple of times in some time. Before we begin, I would like to welcome Dr. Ruma Bhattacharya, Principal of Vijay Krishna Girls College, to give a welcome address.
Good morning to everyone. This is a special international session with angel investment and venture capital funding opportunities for early stage entrepreneurs. And it is being organized by IIC of R&D Cell and IQAC Vijay Krishna Girls College in collaboration with WBIN. I extend my heartiest welcome to the special guests today, Paula G. Rezende and Arihant Kothari in this session. And I know the topic of discussion is for all those who are very much interested to start I would say proposals for business, plan to attract investment, startups mostly, I believe. And this would not only, this session, I know will help them to strategize, to think properly, and to, understand the way the proposal should be made so that it becomes very attractive. We often see these TV shows where there's a group of judges judging the startups and giving them investment funding. I would like to think that our students also would be, motivated to do such startup, should venture into startups that would help them to set up their career in their future path. Wishing welcoming once again everyone, and thank you to WBIN for collaborating with us. I hope this session will be a great success. Thank you.
Thank you so much, Dr. Ruma, for those welcome words and for setting the context for the day. I would now like to welcome Dr. Shweta Guha, IQAC Coordinator, and Dr. Rupak Bhattacharya, Coordinator, R&D Cell. If you could just speak a little about the program and before we proceed with our first guest speaker, Mr. Arihant.
Thank you, Madam. And good morning. On behalf of IQAC, I welcome all of you to this special international session on angel investment and venture capital funding opportunities for early stage entrepreneurs. And today's topics are very interesting for new entrepreneurs, for our students to build up their career. So topics are how to write business plan, of course, very much needed, and about tidbits of angel investment. And my special thanks to WBIN for collaborating with us, and I thank our resource persons for their valuable time, and my best wishes to my students and IIC for organizing this session. And thank you very much and all the best. Thank you.
Thank you so much, Dr. Shweta. Dr. Rupak, are you around? If you would like to say a few
Yes,
words.
ma'am. Yeah.
It would be also nice if you could all
Uh,
switch on your videos. I think if we could see each other.
yeah, definitely. I'm visible? Yeah. Thank you for inviting me to give some insight into the program. The R&D cell of our college was established in 2018 and the IIC 1 year back. So part of the program is the international session, angel investment and venture, capital funding, opportunity for early stage entrepreneurs. When we were kid, our motto was to grab a job. But nowadays, I've seen in my students' attitude that they are more into providing job than to grab a job. So to enhance that of their opportunity, the IC was formed. Dr. Papia Ghosh, Dr. Devjani Mitro are the president and the conveners. And for today's program, the credit goes to Dr. Amit Mujumdar, as we all know. So thanks to them and thanks to the organizers from the side of SwitchOn, and very welcome to Paulo and Ariane for their talk. Thank you very much. So best wishes.
Thank you so much,
Thanks.
Dr. Rupak, for those words. I now welcome my first guest speaker for the session, Mr. Arihant Kothari, Deputy Manager, NASSCOM from Kolkata. Arihant takes keen interest in green economics, given his experience in sharing financial wisdom and good governance growth across the globe that focuses on environment as well as on ease of doing business, understanding financial mindset, and behavior of ancient people, as well as Gen Z population. He has been awarded by the Economic Times for his financial thought leadership, well appreciated by many in his niche of bringing in peace and prosperity in the world of finance. Presently working with NASSCOM Startups, India's largest startup ecosystem platform, he brings along a decade of experience in elevating startups from all over in varied forms, investments, market access, enterprise connects, and has engaged with over 100 incubators and accelerators around the world. A very warm welcome to Arihant to the special session today, and thank you for taking out time from your busy schedule for this. The stage is all yours.
Thank you, Ranjita, and thank you, Green Bengal Innovation and Vijay Krishna Girls School for organizing such an innovative topic in terms of what is required for funding and how can startups, early stage startups or new businesses raise funds. So can I share my screen? I just have one slide, so if that is possible. Yeah. Yeah, so is my screen visible?
Yes.
Yeah. So basically, what I'm trying to do is in terms of, first, let's take a step back in terms of what do we need to take care of in terms of whether a startup is ready for funding. So broadly, as the slide mentions, 4 structures: good team with full structure, be it your tech capabilities, be it your business capabilities, be it your human resource person or your operations person. Traction, how is your startup performing, growth over time? Keep that measure in place. Are you using technology with post-COVID? This has become all the more important. And do you have customers in terms of testimonies, reviews? Could be initial first few customers or like many, so depending upon the stage of your startup. So besides that, culture, community, and character, are you having good business habits in terms of is the culture good in terms of are you into some sort of business that is helping nature, that is helping the society, so that gets an edge over the others, and of course your character in terms of giving before taking. So these are good business habits that my experiences in terms of having interacted and worked with so many startups. And what are the options available? Options available also I would like to cover in terms of very briefly and see that I've abbreviated is as DEGI. DEGI as in Hindi means will give. So will give you funding is debt funding in terms of where you need to pay interest and get the fund. There's no such investor interest apart from getting returns on the money is invested. Equity investment in terms of investors taking equity, that means they become part of your business and of course they get a share after everybody else has given. And then there are grants available in terms of government grants, in terms of other company CSR grants, and there are innovation enablers, incubators, accelerators like us. So below 3 pictures, I won't name these pictures. I've just kept these pictures in terms of like, you know, because I want your pictures to come out. So basically, these are examples of startups who have like been bootstrapped or been part of accelerators or been part of or raised IPOs and been extremely successful. So it's not that if you don't get funding, you don't become successful. If you don't get funding, you don't go to that IP route. If you come to an incubator accelerator, you don't grow big. So it's all about your mindset. It's all about your intent. It's all about your perception. So it's your turn now in terms of raising funds. So like having said that, I would now like to just briefly mention on the roles that investor plays in terms of when the funding is raised or the funding is supposed to be raised. So just give me a second. So basically, primarily, if we cover, it's the regulatory role in terms of shaping up your rules and regulations in terms of like how will the structure look like, the organizational structure look like, and how will the hierarchies work. Of course, if the stake is large, then there's a promotional role, basically typically covering on the debt funding in terms of just giving that initial push. And there's the entrepreneurship role in terms of equity funding, venture capitals funding, and other roles. So, and then there's the planning role. Yeah, this of course is gaining importance as we see over a period of time, wherein a lot of mentors take or be part of startups and give set directions. Could be in form of equity, could be voluntary, could be anything, but this of course is taking good shape and seeing good results. So having said that, I would keep my presentation and discussion brief and at this point take a pause and see if there are any questions.
If we have any questions, we can just unmute ourselves and ask the question. Yes, please go on with your question. The question from Titikshika Goswami is how to start with bootstrap.
How to start with?
Bootstrapping.
Bootstrapping is easy. First, you build your product, and then, as said, that there are family and friends in terms of asking them for help in terms of who can be a potential client, not asking them for direct money, but who can be the potential client, and then taking that step forward and seeing the target. And of course, once you build, be in the part of the ecosystem, show people your product, show people your concept, take people's ideas, you get to know who would be your first few targets, and from there the client pays you money, and there that is how you ask for referrals after delivering a successful product or a service and take it to the next level. So that is how, if you were to bootstrap, it takes shape. So how many of you, if you can see some indicators, are looking to start up or are startups?
Dr. Amit, do we have any entrepreneurs there?
Yeah, I can see some in the
Yes.
chat. Yeah, so
Shagnika Goswami. Shagnika Goswami, would you like to just unmute yourself and
yeah, we would
Yeah.
like to know more about your idea and like
yes.
where are you stuck? What's keeping you from stopping?
You can unmute yourselves and just ask the questions and talk about yourself. Shagnika?
Good morning, sir.
Morning.
Sir, actually, I'm interested in boosting the education system of our country.
Okay.
Currently, I have no idea, but I want to get. I want to do a startup over this.
So what's stopping you from implementing that idea?
Sir, I want to use the technology to boost the education system.
Yeah. Okay. So yeah. So I'll drop in. My email ID is very simple. Drop me your idea. If technology is stopping you, then it's my fault, or rather, we at NASCOM can help you. So arihant@nascom.in is my ID. So drop me a mail on the idea and let's see what cost-effective way you can use technology and move on. I see a question from Tisika. Can freelancing help in Bootstrap? Yes, certainly it can. And it is always a added revenue to the business that you are doing. If you are a product, your freelancing is a service plus. So many a times when you go for larger rounds, you're stuck, and freelancing certainly gives you a lot of boosting when in that working capital need. So yes, freelancing certainly helps. Sisa, so would you like to say a few words about your startup so that we can all hear and see what?
Good
Uh,
morning, sir.
Good morning.
Sir, actually, I have an idea that to build a sensor type t-shirt which can automatically sense the environment and change the temperature for human beings. Like in summer, we really feel so much wet, and in winter, we suddenly feel so much cold. To sense that environment and to automatic provide individual environment uh, for individual people. So it is basically going to be a smart t-shirt.
Okay. Okay, very nice. So, so what's stopping you from implementing? You have an idea, but what's stopping you from implementing?
Sir, actually, I don't know how to get started with. Like, I know that here AI and machine learning is going to help, but how to start the funding and how to choose a right business partner, that is my actual problem.
So, basically, what happens? I'll give you examples from other startups and other ecosystem enablers. They start from the college they pass out. They do experiments from their own labs after getting two, 3, 4, 5, maybe 10 years corporate experience. And then they start from their own lab and experiment because that alumni connect is built. And then the teachers, the academia is very supportive in terms of enabling these ideas. And once these gains acceptability in market in terms of whether 5, 10 people start wearing, and then people start knowing. So that is how you should start. You should start with somebody, maybe your friend, maybe I won't suggest family, but your friend or your ex-colleague. They are typically the best partners that we've seen over interacting with thousands of startups. So or either through a common connect in terms of your friend's friend or your college alumni, and that is how you should start.
Yes, sir.
Okay, fine. Then if there are no more questions, I'm done. I'm always available at arihant@nascom.in, and you can drop me a mail and be happy to explore and help wherever we as NASCOM can. Thank you, Ranjita. Over to you.
Thanks, Arihant. Maybe you can just stay in for a while Polo speaks. And then maybe again we want to open up the floor for a couple of questions. All right, our next speaker. But meanwhile, do keep on thinking more questions. If more of you have more questions, thoughts, comments, anything, please feel free to think over it, put them in your chat box. Our next speaker for the day is Paulo de Rezende, VP Investments, Network for Global Innovation, NGIN, California. Paulo has 20 years of investing experience, both in venture capital and private equity. From 2000 to 2007, as an early stage venture capitalist at Zone Ventures, working with Tim Draper, where he managed investments in over 30 portfolio companies across 3 funds, securing successful exits with DivX IPO and Nevin Vision sold to Google. Currently, Paulo is raising an impact fund for early stage investments in Brazil and is supporting startup ecosystem development initiatives in Australia, Brazil, India, and Pakistan. A native of Brazil, Paulo is joining us today all the way from LA, and it's quite late at his end, but he has still managed to come over and speak to us. So thank you so much, Paulo. The stage is all yours.
Thank you, Ranjita. Thank you for the warm welcome. Good morning, everyone. It's a bit late here, but it's my pleasure to join you tonight or this morning to talk a little bit about venture capital. I prepared a couple of slides. I am passionate about venture capital, so if you were to allow me, I would spend the whole day and night just talking about this topic. So I try to limit my comments a little bit, and there is much more that I can talk about. There are additional slides to that, but I would like to first provide an overview of our discussion. So when you think about funding a new venture, there are a variety of sources and resources available. If we look here at this illustration, we have the axis of the horizontal axis, we have the amount and the risk. So here to the left, we have a higher risk, meaning the company is still emerging, it's very young, there's a lot to prove, there's a product to be made and developed and sold. And further to the right, that means that the risk of the investment is lower, meaning you have already identified your market, you know your product, you know your price, you know your customers, and now it's a matter of growing the business, but there is less risk. So even though here where I'm talking about a lower amount of risk, we are talking about higher amounts of money, of capital, increasing amounts raised, the fact is that there is a inverse correlation with risk. Like you are able to raise more money, the less risk you are. When you are at the beginning, a lot of risk, you are going to raise a smaller amount of money. And then there are, on the vertical axis, there are ways where you fund your company, you raise capital for a company that don't dilute your ownership, meaning doesn't mean that you are attracting new co-owners, new shareholders to your company. At certain point, in the certain kinds of financing or funding, those will mean that you are going to have additional partners, shareholders. Therefore, your stake of the company, how much percentage you own of the company, is going to go down. So these are the two axes here. So just to go back to what we were talking before, in terms of bootstrapping, bootstrapping is a broad spectrum of opportunities for you to grow your company without sharing your ownership, without dilution, as the word we use typically. You are not bringing business partners who are going to co-own the company with you. That's why it's non-dilutive. And then you can go for the early stages, high-risk periods, to something even further down the road where there's not much risk. And if you think about angel investors, the angel investors, for instance, or family and friends, they are in this region where you are talking about higher risk. You are talking about starting the company. There are a lot of things that need to be identified and go well for the company to succeed. Therefore, there's still a lot of risk. And then if you're talking about angel investors in particular, they provide you the capital, they provide you money, but they want something in return, which is shares in your company. And that's where the angel investors are on the diluted side. But for my brief discussion here, I will focus on these two green areas which are related to venture capital, particularly on the early stage of venture capital. But this is just to show it is complicated, it's finance, it can get even more complicated than that. It's just to show there is a spectrum of opportunities, a spectrum of venture capital, or even can be your family, your friends that are making an investment in your company. And we can go back to this in the Q&A if needed. So speaking specific about venture capital, what is venture capital? Is one of the forms of financing of new businesses, as I showed in the previous chart. There are multiple forms. Venture capital is some of them. It's typically used to finance new companies, it's startups that are growing fast. And the way it works, the investor that is providing the capital is purchasing shares in your company. So it's going to be a co-shareholder. The money that is being invested in your company is going to be used to develop new products, new services, and help the company to grow. Besides that, a typical venture capital investor is not only giving you the money, but is also providing expertise and participating in your growth, so that you are not alone in this journey, but you have someone who is a financial investor in your company, so has a alignment of interest in your success, because if your company is successful, those shares that the person acquired are going to be more valuable. Typically in venture capital is a mid to long-term orientation, meaning it's an investment that takes a few years, let's say 5 to 7 years, until the company is at a stage where that investment can be what we call liquidated, meaning the company can be sold and the investor sells the shares with the rest of the owners or the rest of shareholders. So it's a patient form of capital. It's not like a bank where after 1 year or after 2 years, you have to start paying back that amount. On the other hand, it's longer term, but you have a different sort of influence in venture capital because you acquire a new partner shareholder, whereas in the bank, it's just a loan is a participating. You have a question here. If two business partners are going on a share, then it's a venture capital. Titiksa, I think if I understand you correctly, you're talking about two partners who are equal, two co-founders creating a new venture. That case is not a venture capital. A venture capital is when someone provides you the capital and you give to that person or investment fund shares in return. So that person is buying shares in your company, but is not going to be on a day-to-day basis working with you. It can provide some advice and help, but it's not necessarily going to be in a day-to-day. And that person provide the capital, got the shares. So it's a different relationship. Just if I understand your question, is a different relationship from a traditional business partner in the sense of a co-founder. I want to call attention here to this slide that is very important at the bottom, where the venture capital is looking for a financial return, right? So someone invested the capital, buy those shares, but that person is expecting to have the capital back with a profit. So this is not a philanthropic effort. This is a financial investment effort. So imagine that you are buying shares in a company that's traded in the stock exchange. You buy those shares for a while because you believe a good company, it has room to grow. And after 3-4 years, or in the case we said here, 5-7 years, you want to sell your shares and have a profit. That's the same process as a venture capital investment, where there is a search for a profit in that motivation. So when we talk about venture capital, there are 3 major stakeholders that you need to keep in consideration. And this is particularly important because when you are going to raise funds, when you're going to solicit investors for capital, you need to understand what is their mindset so you can position yourself properly. First, there are the investors. These are the people who own the money. They are the capital owners. They are looking for a financial return on their investment. So they are going to make investments and they want that those investments provide a positive financial return. Some of these investors may have additional non-financial objectives. For instance, you are going to meet investors that want to have a positive social impact. They want the companies they are funding not only be profitable and provide a return on their capital invested, but also to create jobs. You might find other investors who want to combat climate change. So they are going to invest in companies that one way or the other provide the financial return that I mentioned, but also mitigate climate change or reduce carbon emission. So these are the capital owners, the investors. Then you have a intermediary, which is a money manager. We call it a fund manager. So the capital owners provide the capital to someone who has the expertise, the knowledge to manage that capital. That person is going to select what are the good investment opportunities. is going to invest in some of them, not all, is going to monitor the companies in which there was an investment, and at a certain stage, let's say, for instance, 5 to 7 years down the road, is going to sell those shares to return the capital. So this venture capital fund manager is an intermediary in the process, is not the owner of the capital, but it's particularly important to highlight this role because many times when you are going to look for funds for your company, be that from a traditional venture capital fund or another structure, you'll be many times talking to this manager, this particular stakeholder, who is not necessarily the owner of the capital, but has an obligation to take care of that money, what we call fiduciary duties, to the owners of the capital. So that person needs to be diligent, be careful where they make investments, because the money doesn't belong to the manager, belongs to investors. And last but not least is this set of new businesses, the startups that are looking for capital. They are going to get their amount of capital for multiple uses, let's say for business growth, and they are going to operate the business on a day-to-day basis. So these are the entrepreneurs, the executives, the founders who receive the capital and then will operate that business with the capital that was provided by the fund. So understanding the three motivations of the three groups, I think will help you a lot when you go out and consider looking and talking to different sources of capital, understand what's their motivation and how they are looking at this. So when we think about how these three players work together, is the first step is the investors, capital owners, provide capital to a fund to be managed by a fund manager. The fund manager will then identify, select, negotiate with potential invested companies and invest in some of those companies. That's what they call portfolio companies, companies that have been invested by a fund. The companies get the capital, they grow, they will do their business. In exchange for the capital that the companies received, they are giving shares to the fund. The fund is going to monitor those companies. When the right moment comes, when the companies are mature enough, that particular fund is going to sell those shares. And there are a number of ways where we can discuss how that's done, with the profits of that sale of the shares returning to the original investors. So you see that there are different processes going on, and this whole cycle from 1 to number 4 might take, as I mentioned, 5 to 7 years. Sometimes it's much faster, sometimes it's lower. Over the last few years, angel investors have become more organized, and even some angel investors have a very similar structure that you see here on the screen, where they have some sort of intermediary entity, a manager, to help them to identify, select, and invest and monitor on the best companies. There are a lot more to talk about this particular, how each round of financing works and the details of diligence and so on. I just didn't want to complicate too much. So I will turn myself to some of the questions that are here in the Q&A, and please feel free to bring additional questions. So one question is long-term orientation of venture capital. Yes, venture capital involves investing in small companies that need time to identify their markets, to grow their markets, to have a customer base, to improve their products, and so on. So it takes time. It takes time for you to build your company. Therefore, it takes time for that investment made in your company to mature. So that's why it's a long-term, long-only orientation, meaning you are investing in the success and growth of the company. At the same time, you know that will take a few years. Typically, I would say 5 to 7. You might have very successful exceptions with 3 years or less, but a rule of thumb is 5 to 7 years of a maturity to a moment where you can sell those shares for a profit and return the money. You asked me here if it's related to the stock market. Yes and no. The financial mechanisms where you think about investing in the stock market are very similar to what you see in venture capital. But there is one very important difference. In the stock market, these companies are much larger. They have a lot of regulations to present their financials, to provide information to potential investors, shareholders, and so on. So there's a lot of publicly available information disclosed to the investors. When we are talking here at venture capital, you are also, as an investor, buying shares in a company, but this is a much smaller company. The number of regulations which that company needs to comply compared to the larger company is a much smaller set of regulations. So you have a similar mechanism in the sense that you buy shares, wait for a period of time, eventually try to sell those shares, but the companies have different sizes, they are different stages of development, they're subject to different regulations. So in that sense, I would say it is a bit different than what you would have in the public stock market. But for you to understand the motivation of an investor in buying shares for a company and making that company grow, I think it's a good metaphor to think how the public market, equity market works. You were asking about, yes, fund manager. Let me just go back to my slide here. Let's see. I'm not sure if I'm sharing the right one. One second. Yeah. So you are asking here if this fund manager gets his share from the startup. The fund manager is acting on the behalf of the investors, so he's a representative of the investors. There's a lot of contracts and agreements regulating this relationship between the investor and the venture capital fund, between the fund and the startups. But basically, in order for number two to happen, meaning for the company to receive the capital and sell shares back to the fund, you have a number of agreements that regulate how that is done. The venture capital fund or the fund manager is going to be paid a percentage of the profit that is generated when this number 4 happens, which means when the shares are sold. So the fund manager doesn't get a portion of the shares for his or her own behalf. It is always acting on behalf of the investors. And when that number 4 happens, meaning the sale of a successful company happens, that's where the fund manager who managed the investment along the way gets a profit participation on that profit. So it does not necessarily get shares on his own name. It's part of the profit that is generated to the investors, and then that profit stays with the fund manager. There's a question about turnover. I'm not sure exactly what is the context of your question, but typically turnover is a expression that we use to represent sales or revenues. So if you see a company that sold 1,000 units at 10 rupees each unit, or $10 each unit, that's $10,000 over the year. The turnover of that company is $10,000. If turnover in that sense is representing what we talk about in terms of sales or revenues. So turnover could be a word which is synonym for sales in that case, or revenues. Share and equity are both the same thing. So let me see if I find a good example here. Yeah, so yes, they are the same thing, but equity means participation in the capital of the company. The share is the unit of that capital. So let's say that you have a company, like in this example here, the company needs to raise $100,000. So the capital that a company is raising is this. In order for this money to be entered the company, you have to do some calculations and negotiations. And let's say that the investors agree that they are getting 20% of the company for $100,000. In other words, they are saying that the company itself, prior to the money coming in, therefore pre-money, is worth $400,000, and the new capital coming in is $500,000. Therefore, what we call the post-money valuation, which is 400 pre plus 100 invested, 500 total post-money, is 500,000. So here, when you ask about what is equity, the equity value of this company in this example is 500,000, right? How you divide this 500,000 in shares, that is up to what is available, I mean, what makes sense to the company. So you can have common shares, or you can have shares of preferred stock, and you, depending on the regulations, the situation, you can define what's the value of one share. So let's say that, for example, the equity value of the company is 500,000 as here, and we decide that the value of one share is $500. Therefore, you have 1,000 shares in this company, and each share is worth $500. The total capital, the total equity in that company is 500,000. So the share is just the unit that you use to make it easy to provide shares to an employee or to sell shares to investors, and it's a division of the overall equity, as we call that. So you were asking me to explain again the turnover, is that? I think it is, right? So imagine you, I think, I'm not sure if you want to sell the smart t-shirts, but let's say that your business is selling smart t-shirts, just for an example. Each t-shirt costs $100, and you are selling 20 t-shirts per month. 20 times $100, that is $2,000 of sales per month. So your turnover every month is $2,000. That would be when turnover is used in the sense of sales, of revenues. So it's how much revenues, how much sales you are generating in a particular period of time. We can say turnover per month, per week, per year, depends on how the case is being used. You asked me here about how to avoid financial risks. There are a number of financial risks, but basically for a startup, I think the most important one is not what we call run out of cash, meaning you have a certain amount of cash, let's say in the bank, and use it to pay your suppliers, to pay for your employees' wages. You need to pay taxes, you need to pay rent on your office or facility. So you need to have a cash flow, meaning money coming in because you know you have expenses, money is going out. The balance of this cash flow, how much comes in, how much comes out, is the biggest financial risk for any startup. So at the end of the day, if you are trying to manage the financial risks of a generic startup, the first step is to make sure that you have a cash flow where you are not spending more than what you have in the bank. You are not spending more that is coming in. So I would say this is the biggest and first important financial risk to be managed within a startup. Depending on the activity of your company, then of course you are going to go after different additional financial risks. But in general, most startups fail because they spend more money than they make, or they more money than they can have. So there must be certain equilibrium over a period of time, so that you are not always reducing the bank, the balance in the bank account all the way to zero, right? Over a short period of time, it may be, of course, you have a month where you bought new inventory, that you hired 2 people, you are spending a little bit more than you are making, but the idea is that when you sell that inventory, when those 2 additional employees become productive, the money is going to come in and the cash flow turns positive again. But over a period of time, the biggest financial risk is always managing cash flow. Yes, you're asking about equity, total, and share is the division of that total. Yes, that's correct. Equity can be used in multiple forms, the word equity in multiple senses, but for this discussion here, the equity of a company is the total, and the share would be the division of the total. You have a question about equity and share. Yes. I don't want to complicate too much, because imagine that you can borrow from a bank to have your business operating, right? When you borrow from a bank, that is not equity, that is debt, that is a loan from the bank. So when you're talking about equity, is about the capital of the company. And when we are adding, we want to differentiate equity from debt, meaning loan from the bank. And that's why the example I showed there at that moment with 500,000, that was about equity, about the capital of the company. And then when you have that amount of capital, you divide that in number of shares, and each share represents a slice of that total, a part of the total. That's why if you have $500,000 in equity, and you have you have shares that each one is worth 1,000 shares times $500, that's 500,000. Therefore, that's the total for the equity amount. There's a question, how to reach the overall audience. Some big startups of valuation of crores reach only 8 to 10% overall population. Yes, I will try to address your question, but the reason that certain startups are incredibly valuable is because of, as I mentioned before, cash flow. So if they have a large market potential and they are growing fast, even if they are only, as you mentioned, addressing a portion of population, but they eventually, over time, they can address the rest of the population. If they have a positive cash flow today, they are growing fast. What financial people do, we calculate and project over time. Well, this company is only at 10% of the market, but has very good profit margins and is able to grow fast. So I project the growth for the company for the next, let's say, 5 years, and do analysis of its cash flow, and then I do some calculations, which means bringing that cash flow to present value. And that's how I realize I calculate the valuation of the company. So when you ask a situation like that, well, company is still not overall active in the whole market, but it's valuable so much, is most likely because when you project that company growing to 50% of the market with high margins, with high growth, that becomes a very strong cash flow, to be precise, a cash inflow, money coming into the company, and therefore that company deserves a higher valuation. That's the simple version of a much more detailed calculation that goes into finalizing that company valuation. So you ask here how to generate the capital for the company. So the capital is at the end of the day is your know-how, is your expertise, is part of that capital, your ability to manage the business, your ability to create a product that is very appealing to the market. So all these tangible and intangible things become the capital of the company, the value that someone will give to the company. In that example that I gave, it was an early stage company. Let's say that investor wants to give you $100,000, and that investor says, okay, you are going to give me shares back. And you say, well, but I don't know what's the value of my company. I don't know how many shares I need to give back to you, right? So that becomes part of a negotiation where you and investor are going to discuss what is the value, meaning the capital in the company, for the work you have done to this date. And this applies not only to venture capital, but if you're talking to investors, angel investors, and maybe friends, family, they want to know, well, I'm giving you this amount of money, how many shares I get, what's the size of the whole pie, meaning what's the size of the capital. In that example I provided earlier, we are talking about so in this example, the investment for $100,000, you are going to negotiate with your investor, potential investor, that your company's capital today is worth $400,000 because you have certain clients already defined, you have products ready to go, you have a team of employees that are helping you. So this is part of a negotiation. There is no, for the 400,000, there is no, how can I say, a specific formula. Is more of a negotiation. When you go to later rounds in the company, so here you are raising $10 million, there are better ways to calculate how much the company is worth, the 35,000, because the company is further down the road, it's more robust, it has a cash flow, it has products. So at the early stages, this negotiation is for the 400,000. It's basically a negotiation between the two parts. There is no magic formula. As the company grows to the second round, of course, an IPO, you can calculate this valuation, the value of the capital of the company, much better, much more precisely than at the early stage. No, you're asking me, the total capital or turnover came to the company is equity. When we divide that with the shareholders, becomes shares. Just to remind you, the total capital, yes, if you divide the total capital or equity, which are used in this case here interchangeably, you divide that in shares, in smaller units, those are shares. Turnover is about sales. Sales is different from capital. Sales, remember, you are, for instance, in the case of the Smart T-shirt, You are selling each shirt for $100. You are selling 20 shirts per month. Therefore, you have $2,000 per month. But the shirt has a cost. So you have to buy the shirt, the sensors, the thermal actuators, and so on. So your profit, let's say, in that $100 shirt is actually $10. The rest, the $90 are materials, is your distribution, is your team, you're paying for salaries, paying for inventory, financial costs, and so on. So you should not mix up turnover as used in sales with capital, because these are two different things. They are still monetary amounts, but they are different entities. They don't necessarily talk to each other. How to know your target audience? Basically here, that's the work of an entrepreneur, right? You need to know you're building a product. Who is it good for? Who wants to buy your product? And at the end of the day, this is the question that the entrepreneur needs to prove, to find the answer and prove. So you need to identify who wants to use your product, who wants to pay for a product, who will pay again and again. And this is the hardest part of the business creation, because it's sometimes much easier to go into a lab, create a beautiful product, but identifying who is going to buy it and for how much, that's the hard part. And that's the entrepreneurs, that's the founder's job, to identify the need in the market and go and supply that need. And if you're coming from the other side, you're coming from a product, you need to find where is that product going to be needed. And that's something that ultimately the entrepreneurs do. There are multiple methods to how you do your market research, how you test your products, how you test your pricing, and so on. But this is something that if entrepreneur has to do, nobody will do that for you. You're asking me here about choosing the right co-founder. If you think about the length of a startup, it's going to take multiple years to have a progress and success. So you have to choose your co-founder, excuse me, incredibly well. You have to look for someone who has similar values as you, meaning moral values, ethical values, someone who has similar objectives as you do. So why are you doing this business? Why are you creating this company? You need to find someone who has similar ideas, doesn't need to be the same, but they have the similar motivations. Someone who has a time frame that's similar to yours. So if you think, well, I can sustain this business for 5-7 years, I'm fine, and later I see what will happen, and then you are looking for someone else, and someone says, oh, I need to do this in 2 years because after 2 years I want to change careers. So you basically need to find people who share a lot of the values you have, a lot of the goals you have for a company and career. And then besides that, going beyond the personal level, someone who has complementary skills. So let's say you are a marketing savvy person, you know a lot of marketing, social media, but you don't know much about engineering or product building. So you would look for someone who has those skills that complement yours from a technical level, but from a personal level, you need to find someone who has long-term goals that are aligned with yours. Yes, you can go without a co-founder. If you look at history, many companies have been founded by only one person, not a team. There are advantages and disadvantages to that. Particularly at the beginning, having co-founder or co-founders, plural, may make life easier. If you're working alone to convince people that your product is good, as opposed to having a team of 4 co-founders who all are at the same time working hard to demonstrate the value of a product. So these are different situations. I don't think there is one universal reason to say this is the right way or the wrong way. I think in general, you find more companies founded by two or more people, meaning a co-founder situation or co-founders plural. But that doesn't, I mean, you will also find companies that were successfully created by one individual. Team building is a very important aspect of creating a business, because again, think about the length of time that will require for that business to be successful. You're talking about multiple years. So you want to make sure that your team shares those values that I mentioned before. At the same time, the team is from a skill set complementary. You have people with different expertise contributing to the team. And also, what is another part is that you're dealing with human beings. So personality is particularly important, right? So it doesn't help to have a team of highly educated PhDs if they don't get along, they don't talk, they fight each other all the time. So identifying the right mix between technical expertise, ability to work together, to be respectful of each other, and also have similar life goals, or for short, mid, long term. This is very important. And at the end of the day, there is no magic formula. You are going to invite some people to join your team. Sometimes you are lucky and everything goes well. Sometimes you are not lucky and you need to make changes and let some people go early because there was no compatibility in terms of styles. So there's a question about micro-entrepreneurship. I think this is a term that is used in different countries with different concepts, different ideas. I will give my my generic understanding, but it might be slightly different from what in the way used there in West Bengal. But typically, micro-entrepreneurship means you are creating a business, small business that is going to be reasonably successful, but doesn't need a lot of people. Maybe you plus one person, maybe 3 people in total will manage this business. So it's not a highly scalable business that will grow and hire a lot of people. Ultimately, when we're talking to investors, they want the highly scalable kind of business because that's where they will make more money, right? If you are talking about a small team of 2, maybe 3 people that will not grow that much, it will be, on the other hand, much harder to find investors. Plus, on the opposite and positive side, it's much easier for you to bootstrap, you and your immediate colleagues to bootstrap and keep the business going. So I would say micro-entrepreneurship is when you're looking to business that are going to have a small number of people involved, maybe less than 5, 2 or 3, and you probably will bootstrap your way to make that business successful. It can be very successful. There's nothing wrong with that. It's just that's not as going to be as large and scalable as some other businesses. You're asking about state government licenses. I know there is plenty of support. I cannot speak about West Bengal or India, but I know that the central government in India has a lot of initiatives. I think it's called Startup India, for instance. They provide a lot of information. I have, while working for Ranjita, seen many of those reports. Specifically, again, to West Bengal or in a particular city, I will not be able to speak to, but I'm sure that you will find plenty of resources of step-by-step with which licenses you need and what steps you should take. Thank you. I probably extrapolated time, but I was just trying to address the questions.
No, I guess that is really, that must have been really insightful and knowledge oriented, I guess, for all the participants here. And I guess this can go on, and we can have more questions. But but in the interest of time, we will also have to wrap up the session for the day. But I guess it was an interesting discussion, and we really see some of the very intriguing questions coming from the participants today. So I'm really excited and really happy to see that. And but if you don't have any more questions, do we have any more questions for Arihant from the participants? Maybe we can take one maybe last question. Or maybe
If like the earlier the better in terms of what stage the government license is needed, the earlier the better, starting from trade license or getting your GST number if you're operating out of India. So the earlier the better. So compliances, if you, as there's a saying that if you don't comply, try, and if you comply, try and feel the difference. So the earlier the better.
all right. Thanks, Arihant, for answering that. So again, I guess I would now request Dr. Debjani Mitra, convener IIC, Vijay Krishna Girls College, to extend the vote of thanks. If we have another question, what licenses new startups are needed? Arihant, do you want to answer that?
So basically, what I see is like getting your MCA, as in terms of your starting up with a private limited company, is always preferred, and that Startup India registration is what most startups do to get the tax subsidies and the tax advantages. So these are the two major things that I see. In case you're in trading, of course, trade license, as I already mentioned. So if you're a private limited company and the Startup India registered, so most of your compliances are taken care of. Of course, then you have to file your taxes and get that GST number and use that regularly. But these two are the primary compliance requirements from a small company perspective.
I think is NASSCOM helping the startups in any of these? Because I see a lot of questions.
Yeah, many of our startups have got Startup India certifications, and we can connect to them. Of course, we have our team of lawyers and legal consultants who help with private limited company registrations and GST certifications. So that can also we can do. Means we can connect.
Yeah. So Arihant has already shared his email ID, and all of you in your individual capacities can obviously reach out to him, right?
I'll write it also.
Yeah, maybe you can just chat, put it in the chat box. Even Paulo, you can mention your email ID on the chat box in any case, if any of the participants wants to reach out to you and email for more questions. But maybe I'll also request Vijay Krishna Girls College that maybe it would be also good if participants, if students have more questions, if the local entrepreneurs have more questions or want a detailed kind of a session or something like that on a particular topic on licensing particularly, maybe then the college can reach out to Arihant, and maybe from the NASSCOM front, Arihant can connect them or provide this, with some necessary support. So I'll ask Dr. Amit, maybe the college can look at that possibility. Okay, all right. So I'll invite Dr. Debjani Mitra, convener IIC, to provide the vote of thanks.
Thank you, Ranjita. May I audible?
Yes, you are.
Yes. So first of all, I convey my heartfelt thanks to WBIN for their cooperation to organize this special international session on angel investment and venture capital funding opportunities for early stage entrepreneurs. Thank you very much. I, on behalf of IIC Vijay Krishna Girls College, Howrah, convey my gratitude and heartfelt thanks to all of you. And my heartfelt Madam, IQAC Coordinator Madam, R&D Coordinator Sir, and IIC President Madam, who is absent today for her university duty. Many thanks to you all for organizing such a program, and special thanks to my colleague Dr. Amit Mojumdar, for whom it is possible to join this such kind of program, and also thanks to all very t-shirt and etc. Their concept is also very good. And last but not least, all the faculties of IIC and all other colleagues of Vijay Krishna Girls College and all the staffs, and especially Ranjita, for you for conducting such a good session. Thank you very much. And our students, thanks a lot for joining this and questioning and also participate in such a way. Thank you very much. Have a good day.
Thank you, Dr. Devjani, for those warm words. And I'm sure the session has been interesting and insightful for all our young students who have joined us today.
And one thing for the students, feedback form is shared in chat box. Please fill it up before leaving the meeting.
Surely. And I'm sure down the line, in the years to come, we will see some interesting startups coming out of the college, some innovative ideas coming out of the college. So we look forward to seeing those. So that brings us to the end of the session. I'll just request everyone, if everyone can just switch on their cameras, and if we could just have a group photo, then I think that would be nice as a remembrance for everyone. So I'll request everyone to switch on their videos. I do see some more videos not being turned on. If we can all turn on our videos, please. Okay. Quickly, on my count of 5, we'll click the photo. So just quickly switch on your videos and I'll count to 5. That 1, 2, 3, 4, and 5. Maybe one more. All right. Thank you so much. And thank you, everyone. Thank you, Paulo, Arihan, for joining us. And thank you so much. We'll stay in touch and stay connected.
Thanks, everyone. Bye-bye.
Thanks.
Bye.
Bye.
Good thanks with your startup. Thanks.
Bye.
Bye.
Thank you.